Time is 2:30, and they are trying to push it into 2:30. QQQ is breaking out above at 2:30. This might be a breakout above 2, or it just pulled back off the 5-minute. What the hell is that? Yeah, it just pulled back from the top 20 cents. So we'll see what happens. Candle closes in 5 seconds. We're dancing on POC. The MACD QQQ bullish. The MACD on QQQ is bullish, yet we keep doing some weird stuff at the top. With the candle looking, I'm just saying, this is still bullish, but I'm just saying we're doing some weird stuff at the top because we're arranging here, it looks like, for a little bit. Oh, your own pal is alive.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
Time is 2:30.
We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year.
We broke out above 2 p.m. candle. Looks like we're going above right now. I said that in the WhatsApp
year.
group 30 seconds ago.
Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year.
Possibly below 2 p.m. level right here.
Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment.
I'm not in anything right now.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures.
I called it out on the WhatsApp group.
Beyond the next year or so,
I called out best safe exit up here.
Most measures of longer-term expectations remain consistent with our 2% inflation goal.
Time is 2:35.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain.
We might go for the gap fill.
Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
And that is the end of.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%. As I mentioned, even excluding tariff effects, the labor market's solid, historically low unemployment, financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Oh my God.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
Holy shit. So, I don't want to go back in, but like that shit is flying so
essentially
fast right now.
The statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit.
1K to 1.2K in a fucking minute. Holy shit, I did not get that, but like that literally just went there in a minute.
Not add to the kind of certainty you might need, or is it you're waiting for the economic effects?
Market dumping.
No, I think we're still. So you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermediate period. But we're still, a ways away from seeing where things settle down. We are clearly getting more and more information, and you know, I
We're
think at this
retesting.
point, people's estimates,
636,
our estimates,
62.
outside estimates of the
Candles are insane right now.
likely, you know, effective
I think the
effective
MACD is
level of
super
tariffs
bearish, though.
is not moving around
Candles
that much at this point.
crazy.
But at the same time, there are many uncertainties left to resolve. So yes,
Candles
we
are
are
nothing
learning
crazy. I
more and
literally
more.
told you
It doesn't
235
feel like
rejection rate.
we're
Like, that's just
very
crazy.
close to the end of that process, and that's not for us to judge.
240.
But it feels like there's
Wow,
much more to
it's at
come.
1.38K. That's
You know,
insane.
as well looking ahead.
Somebody got puts here, bro, for 1K. It's at 1.4K now. Holy fuck.
Axios. This morning we got a GDP report in which final domestic private purchases decelerated
crazy fast.
slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures.
Wow.
Are those not signs that monetary
240,
policy is
240,
a little
folks.
too
Best safe
restrictive
exit right now. Best safe
given
exit.
current economic conditions?
So the GDP and PDFP
Big ass red
numbers,
candles. We do not know if
came
it's gonna
in
go
pretty
lower.
much
You gotta let
right
this
where
shit
we
bounce.
expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data,
This
GDP,
shit is
private
crazy.
domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to
This is
a little better
crazy.
than 1%, 1.2%, I think, in the case of
Crazy
GDP
5-minute
for the
trade.
first half, whereas it was
Crazy
2.5
5-minute
last year.
trade
So that
from
has
the-
certainly
from the
come
tippy
down.
top.
But
From the tippy, from the
if you look at the labor
tippy
market,
top.
what you see is, by many statistics, the labor market is kind of still in balance.
1036,
It's
right?
things
1030.
like quits,
Sorry, I can't even fucking talk.
you know,
Two-
job
oh my
openings,
Lord.
and let alone the unemployment
Puts,
rate.
puts.
They're
Go,
all
go, go.
by many measures,
Holy
very
crap, they're
similar to where
going.
They were a year ago. So you do not see weakening in the labor market. You do see
I'm
a
not going
slowing
in, but
job
like, holy
creation,
fuck,
also
they're
a
going.
slowing in the supply of workers. So you've got
That
a
shit went
labor
to
market that's in
1.6K.
balance,
Oh my Lord.
albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is
241
above
bounce,
target,
240
and
bounce.
even if you
Try.
look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, you know, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs before we get?
Yeah, now for workers, and kind of, you know, so
Taking this- that's all it
maximum
ever is.
employment.
Candle
to,
on
I think,
SPY.
recognition of your
did not
thinking,
know
and
we
we
did that.
certainly had that today. I think, you know, it may
SPY
well.
puts crazy print from the top.
I SEP, and I
Times
don't
two-
like just say that, you know,
Bounce.
we haven't
This
made
is
any
bounce
decisions
sticking.
about September, monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and
POC
there are
touched.
a range of views of what the neutral rate is at this
We
moment
touched
for our economy,
2
and so
p.m.
others may say
algo
it's
candle.
more restrictive or less
We
restrictive.
call this an
even.
algo candle, right, guys? Look
You
at
know,
how we
we're
printed
gonna
on that
be,
shit, right? Look how we printed on that shit, going
at
down,
some
going up,
point,
everything.
when we return to moving toward a more neutral
Exact
stance,
time is
we'll be
2:45.
making that
Bullish.
slightly looser policy.
Trying to look into 245 still.
Nick Timmeros, The Wall Street
Look at
Journal.
This is in and out,
Chair
in and
Powell,
out. Yep, long in
my
and out.
question is
You're
about
right,
what
in
have
and
you
out, in and
learned
out.
over the
Candle
last
risk
few
is
months
crazy.
about the
But if you
inflation
deduct
generating
through the cycle,
and price
if you use
pass-through
time
process? And
confirmation,
just to
you're
drill
good. That's
down,
all
the
I'm
June
saying.
CPI report showed evidence
All
of
I'm saying,
tariff-induced
shit
goods
happens so
inflation. Now, the tariff landscape
Still a bounce.
is
Because we're
only
above
starting
2
to be
p.m. candle,
settled
right?
with some of these more
Above.
recent deals.
Anything
Given the
above-
lags between when
Ooh,
tariffs are announced and
Be
when they
careful.
show up in goods prices,
Be careful, long.
is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected.
Not even
at the
going
beginning,
down.
But we never expected
The put
it to
is
be
not
fast.
even going up, I mean.
We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates.
POC
we haven't reacted to
going
new
southward, time
inflation,
is
but
250.
I
This might be best safe exit right now. I'm going to leave right now. Okay, $860. I'm out.
I think the base increase.
We retest the 2 p.m.
efficiently,
right? We might break the 240. We might break the 240 level. I'm not going to lie.
If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do too unnecessary damage to the labor market. So
240 level breaks off
there
right
won't
now.
be
I'm
in
telling
the
you
end,
right now, this is about to
and
break
big
off right
inflationary
now,
problem.
folks.
What
Sorry,
we're trying to
Roland.
do is
So
accomplish that
my bad.
in a way that
240
is
level breaking
efficient.
right now.
But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives,
LOD coming.
do you expect it to add stimulus to the
LOD
economy
right
in
here.
2026? And
Don't-
would
don't
that
be
be
LOD
an
over,
argument
okay?
for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you?
Super bearish.
I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost of keeping rates elevated for longer terms of interest rate charges?
Yeah, no, that's,
going into 1K right
we
now.
have a mandate, and that's maximum employment and price stability.
$940.
And it is, it's not something we do to consider the cost to the government of our
LOD
rate
broke,
changes.
so
We have to be able to
forget
look
about LOD
at
hoping this is
the goal
LOD.
variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central
this,
bank
ready?
does that.
Watch
And
this,
it
ready?
wouldn't be good if we did do that, it would be good
Watch
neither
this,
for our
ready?
credibility nor for the credibility of U.S. fiscal policy. So it's just not something
I'm gonna
we
take profit
take
right
into
now.
consideration.
Victoria.
1,040.
Hi, Victoria Guido with Politico. When it comes to the
can't even-
renovations
there's no time
of
for me
the
to draw
Federal
this
Reserve's
arrow.
headquarters that the administration has been looking into, do you see their interest
is
in that
LOD.
issue as being directly tied to the president's push to get you to lower interest rates?
This was FOMC dump.
Not for me to say.
FOMC
I will say
dump,
we
done.
had a nice visit
FOMC dump, done.
with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive.
They're trapped for
we
now.
started out to do the work,
Best
and
safe exit.
we're very well along on that work, and I was quite pleased to have the President say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that are they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation, but the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will
might break
affect
LOD.
inflation.
I think LOD about to break.
Approach.
So that's policy's restrictive when we start cutting it, will go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump. During those tariffs, washing machines were
dumping into 3 p.m.
But dryers
That's what's going on. LOD about to break on QQQ.
The price of dryers went up too, just like washing machines. So companies will often just go across the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation.
LOD broke.
And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero.
Crazy.
consumers will pay some of this.
Time is 2:55
Businesses
still,
will pay
not
some
3
of this.
p.m.
Retailers will pay
Time is
some of this.
2:55 still, not 3 p.m. They're dumping
But
crazy.
we're just going to have to see it through.
What a dump day.
Just follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Talking about mortgages.
Well, so the housing is a special case, right?
Mega dump.
We don't set mortgage rates.
Time
at
is
the
3
Fed,
p.m.
Right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates.
Out
Might be 30-year rates, might be shorter than that, but it's not the overnight Fed's rate.
2:56 p.m.
Something
right
we don't
here.
have any
Looks like
effect.
they're
We do
dumping
have
into 3
an
p.m.
effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term
now
housing
FOMO, but I'm
shortage
good.
that we have. We haven't built enough housing.
I'm happy where I'm at.
This is not something the Fed can help with, but then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Time is 3. LOD is here.
Hi, Chair Powell.
Divergence
Thank you.
cleared.
Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
What a sell.
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right?
3 p.m.
So as the two targets get back into balance, you would think you'd move in a way
Have a good day,
closer
gentlemen.
to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality
I
of
told
the
you they're
evidence. As I
dumping
mentioned,
into
there's
3
quite a lot of
p.m.,
data
right?
coming in.
I
We'll have to
saw
see.
250 bounce
Well, I
to
guess just in
255
terms
and
of
then 3
inflation,
p.m.
though, for
I
example,
just
like,
was literally
will-
changing charts. You guys saw me live, right?
Some people would point to
I
if it
so much
remains
shit I have
only
to
in
do.
goods and it doesn't bleed over
That,
to
yeah.
services, then
I'm just
maybe
calling it out
that's
loud, though.
evidence
That was 3
that the
p.m.
tariff
He's
effect
bearish.
is going to be a temporary
Crazy
one-time thing.
bearish.
Is that kind of thing affect your thinking, or do you just
Crazy
need to see the
bearish.
number?
The case, right? So we don't inflation necessarily.
He was saying that he was talking. That was the first time I ever tried. Captain Chaotic said, I did? Yeah, I'm glad you did, bro. That's amazing. Yeah, I have some friends that said they like that too. So, oh my, what a bear burn. 345. $345 bounce at 343. 345 bounce at 345. On QQQ into 345 itself. Down here. Another. Do a lot. Maybe let the thing bounce and then one final. What? Out today. Here. And then it was leave and are flying at me. Contracts go up and we're gonna go look once into north. Yeah. 330 is a possible. This is still 2. So just know that. But this is still standing from 305, right? The wind is north or neutral from 305 until it's not. So this is 350. Looking like Colorado to be honest. But time is destination time. 3:30, 3:50, so literally